Cool. Okay. We've got a question from Mark.
Yeah, I might read this one to you because I'm sure it's something that you've come across many times throughout your last few years. All right. So this is from Mark over email, and it's all about share buybacks. And he said, "Hi team, with the recent announcement from CBA regarding a share buyback, I thought it would be a good opportunity to talk specifically about share buybacks in detail, and would be curious to see what the implications would be on someone participating in a share buyback on sort of a lower income versus a higher income, because he believes it's beneficial for low income earners, and anyone in the higher tax brackets wouldn't benefit so much from participating in a share buyback." Thoughts?
Yeah, CBA has announced a big buyback. I think it was like $6 billion it announced. So I know you kind of went into the weeds on this one. So what is a buyback? A buyback is when a company decides that instead of paying a dividend, or as well as paying a dividend in this case, management and the board of directors have decided we've got, let's say, $6 billion and we don't know what to do with it. What we're going to do is we're going to offer to buy back everyone's shares. And so this is the reverse of what Catherine's response was before, where a company was issuing shares. This company is buying back shares. And by buying them back, what they do is they buy them back. They give you money for your shares or some of your shares, and then they cancel those shares, which then brings the number of slices in the pizza back down.
So the company now owns more of itself.
Yeah, or you as shareholders now own more. It might only be a tiny little bit in your actual scenario, but Apple's been doing this for the last 5 years as a company I own shares in. They've been buying back heaps. I think it's like hundreds of billions of dollars now they've bought back. And what that does is that forces the share price up, because this comes back to the pizza analogy. If you have a pizza and a $20 pizza and you cut it 10 ways, that's $2 a slice. But if you have a $20 pizza and you cut it 5 ways, it's a $4 slice. So what they're effectively doing is they're saying, no. We're not going to cut it that many ways anymore. We're going to cut it fewer ways, and then that's going to push up the value of everyone's share. And so what happens when this actually takes place? Well, the company announces it, and then there are 2 different types of buybacks. There are off market and there are on market. And the question here was more around like the tax implications. So it really depends. Like this is actually interesting. I hadn't thought about this in the preparation for today's episode, but a lot of people may own Commonwealth Bank shares from before the current capital gains tax system came into place. So they might actually
especially your grandparents' generation.
Your grandparents, your parents may have got shares in Commonwealth Bank in the 90s, which may change the way you calculate your capital gains tax. So keep that in mind. The second thing is that the amount of capital gains tax that you pay will depend on the price that the ATO says is the fair price for the sale. And I know you did some digging into this, and I've got the actual ATO website here. And basically, in the case of an off-market buyback, there's a beautiful worked example on the ATO website, which we might refer you to. Basically, you may have to take the market value of the shares, not the actual price that you received. So if you sell your shares in the ATO example, let's say you sell your shares for $9.60, but the actual market price of those shares is $10.20, the ATO would actually take it as $10.20. So the market price. And then you've also got to factor in, a lot of these companies distribute franking credits when they do it. Franking credits are those wonderful things that we talked about at the last election. Wonderful if you're on one side of politics, and dreadful if you're on the other side. Can't believe that was an election debate. That was just, anyway. So you might get franking credits, which encourages you to sell your shares because the franking credits reduce your tax. So if you're a high income earner, the franking credits may be of great value to you because you might see this as an opportunity to sell some. But what I would encourage anyone to do that's in this situation is go read the ATO example and just use their example with your numbers.
Yeah.
That's basically it. There's formula there. You can just use their numbers with your example. Because at the end of the day, Kate and I, we're not tax accountants. Yeah. So, we have a tendency to lollygag and just have a bit of fun on the show when it comes to tax. But really, you should go and speak to someone who, as Kate would say, has a proclivity for these types of things.
And there's another link that I'll put in the show notes, but the ATO often has special tax rulings for share buybacks. So they've got a whole page of just like a long list of different ASX listed companies that have had special rulings for share buybacks. So you actually have to look at that document when calculating it. And anyone, like, I guess most people would use their accountant to work that out, but that's something to keep in mind as well. It's not always exactly the same process.
Yeah, it might seem a bit cryptic though. Just go on there, have a read of that document. It's actually really helpful that they did do some examples because things do change, right? So, the examples allow you to adopt your situation into that, and then give it to your tax agent that way.
Question for you: do you think share buybacks are? This is just off topic here.
Whoa,
but do you
off
think
script. Kate's just coming out here.
I know. I'm creating my own question in the Q&A. But as an investor, do you like when companies have share buybacks, especially companies that you invest in, or do you think it's a waste of capital that they could be using for research and development or something else?
Okay, it's very political question. Very political question. I guess the idea here is just to try and think about this through a few different lenses. So the first is like Commonwealth Bank's buying back $6 billion of shares, right? They're also paying a dividend, fully franked. Thank you very much. Now, the thing is that you want the company to do with its money the thing that maximizes shareholder value. So if the company is sitting on $6 billion earning 0.5% interest, why don't they just give that back to the shareholders? If they can't invest $6 billion and get a good return, give it back to you and you'll go and invest it in something. That's fine. And I think that's a good, reasonable way to think about it. In the USA, the mighty USA, they don't have franking credits. So that's why almost always companies in the USA have lower dividend yields, because it's not as effective to give that money back, because all of the shareholders pay tax on the dividends, even though the company's already paid tax on the profits. Whereas here in Australia, the ATO deducts the tax that the company's already paid, which is why we have franking credits. So in the USA, they tend to opt for more buybacks. But over there, there's a massive hoo-ha about this, because the big companies like Apple are buying back like $100 billion of stock, right? This is not a joke, $100 billion. And so what's happening is that the people are saying, well, you should be investing that in your community where you make money, reinvest for jobs and all that sort of stuff. Well, Apple's like, we are doing that, but we've still got money. So we're going to buy back stocks. And as an Apple shareholder myself, I actually like it, because I don't want them to pay me a dividend that's going to be taxed to the hilt. I'd rather them just buy back shares. And that keeps the price of the shares on the market reasonable, and it pushes the share price up over the long term. Now, that's the capitalist side of me. Sure, I want them investing in R&D, but only if that R&D is actually going to make something happen. Like Apple has so much money that for them to create a new Apple Watch, yeah, it's $1 billion maybe in R&D, but they've got $120 billion. So they can't just create 120 different versions of watch. Like, they're not going to do that. So that's as a capitalist, I think they should be investing, they should be innovating, and they should be employing people. But at the same time, I think it's unnecessarily political. That's my view. I just try and act with equanimity whenever I get thrown into a situation like this, and where it becomes really political. Just focus on the actual sense of it rather than just kind of get up in hysterics. But I think overall, yeah, I like companies doing buybacks. I've never sold into a buyback. Like, I've never ever once sold my shares into a buyback. I've never agreed to sell my shares. I just prefer to keep holding them. What a crap answer.
I don't know. It just seems like a company like CBA, that money could do a lot in terms of improving their technology and their products and their offerings, and I don't know, upgrading their services.
The thing is that a few years ago, CBA and all the big banks were basically told no more acquisitions. So following the GFC, you're not allowed to buy anyone else. You're already too powerful in Australia. You can't buy anyone else. So there was rules put in place. So now that CBA is selling a lot of its crappy businesses off to other companies that can take them, they're selling those businesses that they once bought to try and monopolize the market. And now they've got nothing else to invest in. So they really only have two choices: buy buy another company, which they can't do, give it back as dividends or give it back as share purchases. One of the things that you mentioned is like technology, right? Again, this comes back to CBA. I don't know the financials in front of me, but CBA is probably already investing $500 million a year in itself. And so they don't, to create an app, you don't need $500 million. You could do it with $500,000. And so that actually isn't, in terms of moving the needle, they don't need that much money to do that. The only thing that they could really do is expand overseas, which if you look at like NAB or ANZ,
yeah, we've had a pretty
that's a dog's
atrocious track record trying to expand banks overseas in Australia.
Yeah. And so like you look at like in fairness to CBA's defense, their apps actually are pretty good compared to the other banks. They're actually pretty good. Not like I think like things like Up Money are probably better, and ING and all that. But CBA is still investing. It just doesn't need to invest that much more. Anyway.
Well, sorry, Mark, I hijacked your question, but
yeah. Kate, next time send it to the podcast inbox, and then we'll put or drop it in the Facebook community. Actually, that's a really interesting topic. If you think that share buybacks are good or bad, you can let us know in the Facebook community, or just hit us up on Instagram or Twitter, and let us know what you actually think of them, because I don't think they're a big deal, but some people do. There is a counterpoint to be made about these companies being so profitable, particularly in the USA. But yeah, let us know what you think. And you'll find the show notes there, which have the link to the ATO's website. Great example on the ATO's website. By the way, one more thing I'll throw in. The other day, I went on the ATO website, and I didn't know this was a thing, but it's been going on for like 5 or 6 years, I think. The ATO every year publishes a personal investor tax booklet, and it actually takes you through all of the tax scenarios that you might come across. And it explains how you pay tax on dividends, how you pay, what franking credits are. It explains how you pay tax on ETFs, how to do things. Like, it's got all these examples, like pages and pages of examples. If you have a tax question, Google ATO personal investor tax booklet. It's a PDF, and it's really easy to understand. And I was like, whoa, where has this been my whole life? I've been answering tax questions left, right, and center, and it's right here.
So we'll definitely, I'll find the link to that and put that in the show notes. They're going to be pretty chunky today, but hopefully they give people a starting point if they want to do their own research into these areas, which I would always recommend. Yeah, that's it. Yes, it is really good. So, yes, Kate, I think that's it for today. If people want to get in contact and send a question in, just again, how can they do that? Yes, we're checking the emails a little bit more regularly now that we've got a producer on board, podcast@rask.com.au. Or if you want more immediate responses to your question, the Facebook community, which will be linked in the show notes, because the Q&As only happen once a month. So you're much more likely to get a quicker response and some resources to guide you in the meantime if you post the question in the Facebook community. And if it's a popular question we haven't answered before, then we'll definitely put it into a future Q&A episode. There are heaps of really, really smart people in our Facebook community. So then it's actually, we kind of have a no idiots rule in the Facebook group. So it's actually a really good environment to just ask beginner questions and ask intermediate and advanced questions too. So it's all kind of, above the waist, kind of really good, foolhardy thinking about finance and getting better as a community. So jump in there, say g'day, ask your questions. And if you're happy for us to take a few of them for the podcasts and share them with the big audience, please, we would love that. So, Kate, as always, thanks for joining me on this episode of the Australian Finance Podcast. Thanks for listening, guys.